This is the recent T-bill result and it was at 3.9% cut-off yield. And you know, I recently applied for it with a competitive bid with a 4% yield and I got zero allotment for it. So in this video, I'll talk about competitive bids and why did the yield on the T-bill fell again, and maybe give an outlook of what I predict the next T-bill results will be. So how does the competitive bid works is that you are the price maker and you will decide the yield that you are comfortable with, that you are satisfied with, and you don't let the government dictate the yield that you are going to get. So if you're happy with any yield, you could just go with the non-competitive bid, which was what I did for my previous T-bill allotment of 4.19% per annum. I did bid a 10k at non-competitive bid, and this time I decided to bid a competitive bid at 4%. So what happens if you made a competitive bid at 3.9%? Only 7% of these bids will be allotted based on the results. So 7% of allotment is really very little. But if you have bidded below 3.9% at a competitive bid, you will get 100% of your allotment, and that is in full. So even if you bid like 3.91% and above, you will get zero allotment, like me who got zero. And then for the non-competitive bidders, which means that you are just taking any yield that you are given, 77.78% will be allotted to you. But you see, I'm not really disappointed with the results because I was already expecting the yield to be above 4% for me to be comfortable and satisfied. If there's anything below 4%, I would rather not put in it, because your high yield savings account like OCBC 360 is already giving you 4%, and that is risk-free. And maybe some of you may think that 3.9% is really very little, but how about a 5% guaranteed return product from the sponsor? I know your pain learning about investing, because when you try to read about market news, company news, it's all scattered around the internet and information is so difficult to find. And the most annoying thing is sometimes when you click on an article, it is locked behind a paid subscription or a paywall. Now with Momo Singapore, you can get everything, every news consolidated for free, and it's all convenient under one app. For example, if I click into Tesla and look at the financials, I can take a look at the revenue, the indicators, the estimates, and the financial statements. Even interesting information like a pie chart for revenue, and also important business data like total vehicle deliveries and deliveries by model types. Now, even better news is that Momo Cash Plus has upsized to 5% per annum guaranteed rewards. So for example, if you put in $10,000 for 3 months, you get a guaranteed $123 return. And return is 100% guaranteed, redeem anytime with no lock-in, with absolutely zero fee. And if you manage to get one new friend to sign up for Momo, you get an extra month of rewards. So Momo is indeed a great platform to trade stocks with many unique, easy to use tools within the app itself. So check out my link down below in the description and pin comment to sign up for Momo today. So today, let's discuss why did the T-bill yield drop again. I mean, previously it was at the peak of 4.19% per annum, dropped to 4% flat, and then currently at 3.9% per annum. This will be some possible reasons, but definitely I'm not 100% confirmed because no one will really tell you of the exact reason of why it dropped. From a competition standpoint, if you look at the competitiveness of T-bills, then you realize that T-bill, you are actually eligible to use your CPF OA or CPF SA to bid for it. And a lot of people have been contemplating whether to use their CPF OA to invest in T-bill, because you see your CPF OA is gaining you 2.5% per annum interest, whereas your T-bill can give you like around 4% per annum, albeit it's only a 6-month short term. But you see the difference between 2.5% and 4% is really large, right? Like almost 1.5% if we ignore the compounding. So a lot of people are really greedy on this. Many of them have queued up at the banks, fill in the physical forms for them to transfer the OA into T-bills. And you see the difference between competitive bid versus non-competitive bid is that for non-competitive bid, you will only get partially allocated, especially now when the T-bill awareness, knowledge, and the interest yield is so high, right? Everyone is just chasing after T-bills. So some of these people who intend to use a CPF OA may be really competitive, and hence they set up a competitive bid. But you see, the competitive bid rates that they set up is not very high. They will probably lowball like some carousel buyer, right? Like maybe put 1%, 2%, 3% and bring down the overall yield because they want to be 100% fully allotted. This is the traditional game theory, right, where you only want yourself to benefit from the outcome and you want to disadvantage other people from the outcome. Because you see, by bidding really low, you get 100% allotment and you also get whatever the cutoff yield is. It doesn't mean that if you bid at 1%, you will get your TBU at 1%, but you have a higher chance of getting guaranteed 100% full allotment if you bidded at a lower interest yield. So you see, in the end, who suffers? Those who did not bid low, right? Because those people who have bidded 4% or higher, like myself, are not able to get it because the cutoff yield is at 3.9%, which has been put down by these people who are lowballing the T-bills yield. Anyway, if you really want to take a look at the latest news on credit card nerves, on like T-bill results, SSB results, or even the best deals, right, then do join my Telegram group at Honey Money SG, because I will give my first-hand updates right there. But you see, I don't really blame them, because everyone for himself, right? Every man for himself is always a very selfish thing. If people can already get more than 2.5% on their OA, the greed sets in, especially for people who don't really have those financial literacy knowledge. They will see that anything more than 2.5% is good. So maybe I just put like 2.6%. I think that's good enough, and that will pull down the overall T-bill cutoff yield. That is a very layman explanation, but let's take a look at something more macroeconomics. If we look at something interesting, which is the US 10-year treasury bills, you realize that it has fallen from a peak of 4.2% to the current 3.7% level. And in my last video, I talked about the T-bill yield of 4.19% may have been the peak, and it happened, with the reason being that the Fed may be pivoting to a slightly dovish stance, which means that they are more positive of the economy outlook and interest rate hikes will be more controlled instead of being more aggressive. To explain this even further, right, let's take a look at the stock market impact and the Fed position. The next FOMC meeting is at 14th of December, and that's when the Federal Reserve of USA will decide whether they want to hike interest rates by 50 basis points or 0.5%, which is the general consensus, or they want to hike it even higher to 75 basis points or 0.75%. Okay, right now the majority is leaning towards the 50 basis points, so I guess that is the expectation right now. If everything is controlled, okay, inflation is controlled, they don't need to increase a higher interest rate hike, then 0.5% will be generally a good news for the world. And when the Federal Reserve have confirmed this 50 basis points interest rate hike, I guess the market will rally, stock markets will rally, but your interest on SSBs and T-bill yields may be slightly decreasing because people already have the expectation that the Fed is pivoting. But what about the other case? What if the Fed is actually more hawkish at 14th of December and they announce a 75% basis points hike? Then we will very likely see a market crash again and crash to a new low, because it seems that even though inflation is controlled, the Fed is not going to take any dovish action. They are going to increase the interest rate hikes even further by 75 basis points, which is against the consensus. Consensus is 50 basis points only, right? 0.5%. So you see, we are always at the disposal of this Federal Reserve. Don't fight against the Fed, right? So if you want to expect your T-bill yield to increase or your SSB interest to increase, then you'll wish for the Fed to increase the interest rates. But you see, that will crash your stock markets worldwide. And some of us who have been investing in equities may not want to see this outcome. Anyway, for those people like me who have gotten zero allotment for T-bills this time around, I think don't be disappointed, especially if you're using cash, because if we take a look around at the fixed deposit rates in Singapore, they have been slowly increasing. In fact, if we look at foreign banks like RHB and CIMB, they are already offering you more than 4% per annum on their fixed deposits. So if you want to compare some of the fixed deposit rates in Singapore, then kindly refer to my fixed deposit video right here.